Good morning, everyone. Thanks for coming by and checking out the Market Chameleon pre-market webinar series. Before we get started, let's take a look at this shared disclaimer. Be aware that neither Market Chameleon, Dmitry, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinar shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer. And let's welcome Dmitry Pargamanik to this stage, who will be talking about understanding time decay and Vega risk in options. All right, here we go. Welcome, Dmitry. How you doing today, buddy?
Good morning, Will. How are you?
Great.
Yeah. And I think for today's example, what we'll do is take a look at option Greeks, particularly Time Decay and Vega, and set up a strategy and test the sensitivities of that strategy to passage of time and to test that sensitivity to Vega risk or the implied volatility. And it's important because I think that sometimes we get, customers assume that, time decay is linear or implied volatility is linear, and it's not linear. And we'll give some examples today where, when we look at time decay, it accelerates as you get closer to expiration. So we'll take a look at it and kind of give you a visual presentation of what that looks like. So I'm going to use a symbol in our example. Let's go to, let's say we go to Google. And I'm going to type in Google in the search. We come to the Google page, and let's go to the options chain on the left-hand side and click option chain. I'm going to close the menu on the left-hand side or minimize it to expand our screen. And here we have Google's option chain. And on the left-hand side, we have the different options expirations available to trade. So let's go out a little bit further, since we're looking at time decay and Vega risk. And let's say we go to July 18th. I'll click on this. And now we're on the July 18th options expiration. And first, let's set up a strategy, take a look at, the Greeks of that strategy. In particular, we'll look at the Theta and Vega risk. So I'm going to go and just start out with something like a straddle. We were looking at Google around 170.37 is the closing price. We're not open yet today, so we're looking at yesterday's closing option chain. And let's say we go to the 170 strike, the closest strike to the spot price, and we create a straddle. So on the left-hand side, we're looking at the calls. If we click on the ask side of the bid and offer, what it will do is populate a ticket for the strategy, the first option leg, buying the July 18 170 call. You could see call option for $7.35. You could change any of these parameters, but it auto populates it for you when you click on the ask side, assuming that you're looking to buy on the market price. So to complete the straddle, we go to the put, the 170 put, and we do the same thing to the ask side. So the put is 610 bid, offered at 620. I'm going to click on the 620, and now we get the second leg of the strategy. So now we have this straddle, buying the 170 call on July 18th and buying the 170 put on July 18th expiration. I'm going to run this analysis. It's going to use those market prices that were observed, and it comes up with the strategy of buying the straddle for $13.55. And here we have different analytics for it, and this is the risk sensitivity of this particular strategy. And here it's telling us it has 48 Vega and positive 48 Vega and a negative $14.80 Theta. Okay. So keeping that in mind, I'm going to go to another page where we could kind of also change some parameters around to see the sensitivity of this strategy with time and implied volatility, and we'll discuss these two risk parameters. So I'm going to go to the summary here. We're going to click on pricing and risk sensitivity, and here we populate the same strategy. You can see here buying the July 18th 170 call, buying the July 18th 170 put. These are the days to expiration, implied volatilities and interest rates that we observe. And here is that strategy here, $13.55. So that's the initial cost, like we were talking about. And here's the Vega, a positive $47.96, and the negative Theta, $14.76, almost $15. So what does that mean? Well, if nothing else happens, the stock doesn't move, keeping everything constant, what is our risk to time decay? Well, on one day, it's almost $15. Okay, so here's the legs of the strategy. So you can see here, July 170 put, the Vega is 8 cents. So 8 cents times, you got 100 contracts, in one contract, so 100 shares deliverable. So it's $8. So, and this is 6 cents times $106. So you got about, almost $15 in here in Theta, meaning that everything else stays constant, and just one day goes by, the passage of one day, this strategy will lose, is expected to lose $15. Stock stays the same, implied volatility stays the same, everything stays the same except the passage of time. The Vega is telling us that if everything stays constant, so everything else stays constant, stock sits one place, there's no decay, implied volatility, every interest rates are the same. The only thing that changes is the implied volatility goes up one click, then this strategy is expected to make $48. If it goes down one click, it's expected to lose $48. Okay, so keeping this 1355 that we're talking about is times 100, right? Because 1355 times 100 in each contract. And I'm going to close this here. And this is important because these also are not linear. So if we change time, that's on one day. What if we move forward, right? From 46 days, let's say we move forward, and now we're, let's say, June 16th. So today's June 3rd. What does this look like on June 16th? Right, so this is, if I click June 16th, well, we're going to take 14 days out of days to expiration. Okay, now there's only 32 days left. So on June 16th, we have 14 days left, 14 days less. So watch this. I'm going to run this comparison. And now you could see that on June 16th, our Theta now moves up to $17.87. And what this means is that if nothing else changes, stocks at the same place, implied volatility is at the same place. Well, on June 16th, all of a sudden, our theta on that day is almost $18. So you could see that the theta starts to increase as we get closer and closer to expiration. So let's do that again. Let's go even closer to expiration. Let's do July 3rd. So now I'm taking 31, moving forward 31 days. So now you see my theta is increasing, and the Vega decreased because now the options have decayed. They have less sensitivity to, there's less premium in it, right? So the Vega itself also, the Vega risk has gone down. So what you are having here is less theta as we go out further in time, but larger Vega risk. As you get closer to expiration, your theta is increasing, they decay faster, and you have less Vega risk as the longer term options, right? So we could compare. Yeah.
We had a question from Rob concerning theta and time decay. He asked, how can the risk for time decay be more than the cost of the straddle?
So the cost of the straddle, keep in mind, is 1355 times 100. So this is already giving you the times the 100. So it's 13. So this would be like what, 1,300. Or I'm sorry, what's that? Right, $1,300, $550.
And then he's asking, and then he's actually, is the theta simply the number shown or the number times 100? And that's what you're saying.
That's the number times 100. Yeah, it makes it easier because otherwise you're going to get this small number, and it's harder to translate. So this is like your position risk for one share, for one contract. Okay, so this is times 100, all these values. The Greeks are times 100.
Perfect. Thank you.
Yep. So you can see here that when you're just moving in time, right? All I did was move forward in time. The Greeks changed. All the Greeks changed. My deltas changed. My gamma changed. My Vega changed. My theta changed. And they're not changing linearly or equally day by day, right? So like on July 3rd, all of a sudden, I don't have $15 in theta or $14.76. I have $26 in theta. These are important things, especially when you're doing like something like a time spread. Okay, so let's now go back to the current. So this is going back to today's, right? And if nothing changes, it's the same. What if we just move up the implied volatility? So I'm going to move up the implied volatility. Let's say, let's go up. Let's go up to like 32, right? And 32 on each one. So I increased the implied volatility to 32. I'm going to run this. So now let me see what it. All right. So now what we're seeing is that if we increase that, right, in this situation, our theta goes up because now there's more premium. When you increase implied volatility, your options are worth more, so now they have more decay, right? So this is a way to test, well, what would my theta be with implied volatility up like 4 clicks? We could also move that in time and look at it as up 4 clicks and going, I don't know, June 6th. So now I decreased 4 days. And now we could compare what our new Vega position would be and our new Theta position on June 6th. So one more thing we could do is set up a different strategy. Let's say we wanted to do a time spread. And I'm going to remove, let's just set it up from scratch. So let's say we do a time spread where we sell the 170 call. So I'm going to click on the bid this time. So you can see now it's different. Now the July 170 call, the July 18th 170 call, we're selling for 725. That's the bid. And we go out further in time. And we go to September, let's say, let's go to September 18th. And we buy the 170 call for 29.10. Okay. So now we have a time spread on. And you could see there's, even though we're on the same strike, 170, well, the September is $29.10 because it's going out way further. So we have a lot more time premium. So let's run that analysis. And here you could see that we have now a positive Vega and a positive Theta. So let's see how that looks. I'm going to go here, summary, pricing sensitivity. And here, what this is saying is that if nothing happens and just time goes by and implied volatility stays the same, well, that kind of works in our favor because then we get a positive $5. Okay, positive $5 on this decay, and that's because the option, the July 170 option, has a bigger theta. Right, the closer you are, it has a bigger theta. So here we've created a strategy where time is working in our favor as long as the Vega doesn't go down. But we have a lot of Vega risk. Okay, so if the implied volatility goes down, then this could lose. So you could see here, though, that the July 170 call, the implied volatility is lower than the September, which indicates to us if nothing stays the same and the term structure looks similar, as time goes by, we're likely to lose on the Vega, right? Because Vega looks like it's not a straight implied volatility skew across different expirations. As we get closer to expiration, implied volatility also goes down, right? Look at 27.8 with 46 days to go, with 33.5 with 473. So what can happen is as we go, let's say we go out to let's go out to June 17th, right? So I'm taking 15 days out. I'm going to run this. And here's a P&L chart. So if nothing happens and just time goes by, we'll make $86 if implied volatility is the same for both options. But looking at that, it looks like the implied volatilities probably for both options will decrease. So let's just say we take it down one click and one click. So now we have time decay, and we're expecting implied vols to decrease as these options get closer to expiration. And if we run that analysis, so you could see here, one click isn't bad. It's still profitable at 34.58. Let's test it out if it goes down further. Let's say 2 clicks on each one. So here, then it gets at a loss. So you could see here, that what we just tested out was this is a strategy. The time spread would be good if implied vols remained the same and we just had passage of time. But if we're expecting the implied volatilities in the expirations to start decreasing as they get closer and closer and closer to expiration, well, then we got the risk that at some point that implied volatility decline will offset any positive theta or decay that we would collect. Okay, so looks like once you hit 2, then we're at a loss. And just to show you kind of how that looks like, here are the different expirations available in Google. And you could see here, as we get closer and closer to expiration, they start to implied volatilities start to decline. Okay, so that's something to take into consideration when you're strategizing and looking at these options. Like, well, okay, I have to consider not only time decay, but how will the implied volatility and my Vega risk impact my position if, going forward, the term structure continues to look like this with a downward sloping implied volatility. All right, Will, I'm going to stop right there.
Yeah, that was excellent, D. Thanks for bringing this webinar. Thanks, everyone, for joining us. Remember to like and follow us on all the networks. A thumbs up on YouTube is great. Everyone is traveling and in different places right now. Actually, Rob is going to Pittsburgh. Actually, D, his grandson is graduating from high school, and he's attending Pitt in the fall. So that's pretty cool.
Oh, that's awesome. Yeah.
Yeah. Well, great school. Everyone, thanks for joining us. D, awesome job as always. We will see everyone tomorrow. Thanks, buddy.
Thanks, everyone. Stay safe out there and hope to see you tomorrow.
Trade in peace, Chameleons. Everyone have a great day. Thanks, Steve, for doing this for the Chameleon community. Remember, again, like us, follow us, thumbs up. Everyone have a great day. Thanks.